All right, good morning everyone, and welcome to our highly anticipated webinar in tax reform. I'm Stacy Dreyer, the marketing manager for James Moore & Company, and I'll be your host. And with me today to present are Aaron Spivak and Suzanne Forbes, CPAs and tax partners for James Moore & Company. And for those of you who haven't had the pleasure of meeting with or working with Aaron and Suzanne, Erin oversees our tax practice, where she manages and directs the day-to-day operations and analyzes the plans for the impact of new tax developments, such as tax reform. And Suzanne Forbes specializes in tax, accounting, and business consulting services. And she leads the firm's real estate services team, but she also advises businesses in a broad range of industries on tax strategies and planning, transition planning, profit enhancement, and more. So we have a lot of information to cover today, but before we get started, I'd like to address a few items. We encourage you to ask questions throughout the presentation using the Q&A feature, but we have a large number of attendees, so we won't be able to answer all of your questions today. So if they go unanswered, please keep in mind that somebody from the firm will follow up with you early next week to provide an answer. And also keep in mind that the Q&A feature is private, so only we can see your questions. We've also made several handouts available to you today, so if you go to the dashboard on the GoToWebinar screen, you can download the 3 handouts for use after the presentation. And if you encounter technology issues during the presentation, please call that 888 number on the screen and ask for webinar support. And for those CPAs who are looking for CPE credit, this webinar is eligible for 1 CPE credit. So after the presentation, we'll email you a copy of the slides as well as the recording and any additional information you need to obtain your credit. We're also going to have 3 polling questions throughout the presentation. So for those of you looking for CPE credit, make sure that you answer those questions. So without further ado, I give you Erin to discuss some of the key changes for individuals.
Thanks, Stacy. We have over 200 people on the call today, so we're really excited that so many people are as interested in the new tax laws as CPAs are, and that we're here to help provide you hopefully some clarity, but also some solutions that as we kind of navigate through this next year to 3 years, as we start to understand and they clarify the law, we can help you. As an overview, today we're going to cover the individual's impacts, business impact, and nonprofit impact, but we couldn't cover the entire tax law in 1 hour, and we couldn't even really cover all the individuals' changes in 1 hour. So we selected certain highlights that we thought would be useful for you, and certainly there are some provisions that we're not going to cover, and if you have questions related to them, please let us know. One of the big ones that we did decide to leave out was the foreign impact, because it's just such a highly detailed area. There's no way we could even cover it in just 1 slide. We also want to encourage everyone to check our website. We actually have a section on there for tax reform resource services, where we are consistently updating it with articles or links or more clarification as we become more aware of how the tax law unfolds. I mentioned solutions that we have in place that I think we can help with. We've also included this in the handouts and sent some of this more detail with our engagement letters and organizers to kind of help you navigate what's going to happen from 2018 and going on. One of the things is a personalized tax projection prepared under the new law changes. It's not as simple as your tax rate change. There's a lot more that now goes into it, making decisions to say, is 2018, how are my taxes impacted, either taxes going up or going down, and how is that my business interest or my rental real estate or the effect of my charitable contributions going to affect me going forward. We can also do changes to your federal or state estimated tax payments, because the old rule of using 110% of prior year liability may not be applicable going into 2018, and you may want to evaluate whether or not you're going to be paying in too much or the impact of your withholding changes. Under businesses, Suzanne's going to go over this a little bit later, but there definitely is an analysis of entity that you may want to evaluate. Are you still good to be a sole proprietor? Are you good to remain an S Corp? Should you convert to a C Corp? Should you convert from a C Corp to an S Corp? Is the partnership the right answer? We develop tools to help you do an overall general analysis and then really dig deep and make sure that it fits what your goals are for your business kind of going forward. Revenue recognition, there's rules under there that say, hey, you may have the availability to change how you recognize revenue. You may have to change how you recognize revenue. And this can help you kind of evaluate what you're going to have to face kind of going forward, and even under the financial statement rules that now relate to the tax law. And then finally, kind of an analysis of your business expenses and changes to deductibility. Are there some changes you can make today that will affect how you are able to deduct certain expenses? Or should you be prepared that some of the expenses that you previously have been paying for are now not going to be deductible, and you need to plan for that? All right, I'm going to turn it over to Stacy for our first polling question.
Thanks, Erin. So in just a minute, you're going to see the polling question appear on your screen. We'll give everybody a couple seconds to respond to this poll, and then Suzanne will walk us through the results. Okay, we're closing the poll and sharing the results.
Okay, well, thank you, Stacy. So it looks like on our results, 64% believe that they will be paying less under the tax reform. We got 15% that say more, and then 21 just right now aren't sure. Maybe after this presentation, hopefully you'll have a little better feeling whether or not you will be paying more or less, but we're sure here to help you figure that out.
Definitely. Thanks, Suzanne and Stacy. So let's talk about the path to tax reform. This has definitely been a priority of this Congress and a lot of prior Congresses. I've been doing this for almost 20 years, and every year I've heard tax reform is coming, the tax laws are changing. And what I've seen kind of occur is that instead of a full boat impact everything, individuals, businesses, nonprofit, foreign, is that they've done kind of patches of tax, what we call tax reform. And they've also always been sometimes a lot temporary, so that you only need this for 5 years or 10 years. Unfortunately, they weren't able to change that with this comprehensive tax reform that is the biggest one since 1986. And the reason for that is some things they were able to make permanent, and some things, because of what's called the Senate reconciliation rules, which basically means that in order to only need 51 votes in the Senate to pass a law, that they can't have more than $1.5 million trillion deficit under the law. And so in order to do that, they had to put what's called a sunset provision for a lot of these tax rate changes or deduction changes, so that they didn't need 60 votes to pass the law, because quite honestly, they probably wouldn't have had them. After the November 2016 election, we actually had our internal James Warren Company tax update the next day, and I think we all walked in and said, well, the Republican president, the Republican House, and Republican Senate, who have all talked about tax reform being one of their top priorities, if it's going to happen, it's going to happen in the next year or two. I think there was a lot of doubt that they were going to be able to get this through, but they passed it and signed it on December 22nd, and today we're looking at how is this going to impact us, and what are still some of those gray areas that we just don't know based off of the law that they wrote. So what's next? Well, the IRS has its work cut out for them. So Congress puts out the law, and it's up to the IRS to write regulations. You might ask what a regulation is. It basically expands the law and gives examples, gives clarification, and gives the tax professionals, and the which includes attorneys and CPAs, the guidance to be able to give to their clients. This is what they meant when they wrote this law. They also can issue additional IRS notice, rulings, and procedures to help clarify stuff. And one of the first things that they had to do was update the withholding tables for people's payroll so that people weren't over withholding based off of the new tax brackets. They released those yesterday, so you should have, if you have a business, have heard from your payroll company, or if you do your own payroll, you should be able to download those new withholding tables. They did give a caveat that they're to use caution, because they're based off of the old W-4s that your employees filled out. They are going to issue a new W-4, because as you'll see in a few minutes, some of the questions they had asked on the W-4 are no longer relevant, but they expect you to have this in place by February 15th. Some of the things that I'm talking about here are the technical corrections, and they've already mentioned this, that some of the Tax Cuts and Job Act that they passed, they're going to actually have technical corrections, because they might not relate to another part of the code section that directly contradicts each other. And so a lot of times the IRS will go back to Congress and say, hey, you have to fix this. This isn't a technical correction, or this isn't practically applicable. And we saw a lot of that with the Affordable Care Act. If anybody remembers the big hoopla that they came out and said, hey, you're going to have to give everybody you ever pay a 1099. And they came out not even a year later and said, oh, that's unreasonable and unnecessary. We're going to go ahead and change it. The last thing is we got to plan for the sunset of a lot of these provisions, so that although we can make decisions on the forefront for the next few years, you want to be careful of making a permanent decision that if this provision goes away in 2025, then it's now detrimental to you to be still doing that in 2026 if they don't change the law by then. So now we're going to move forward to talking about tax reform for individuals. In general, the individual provisions go into effect starting January 1st, 2018, but are set to expire December 31st, 2025. Some of the notable individual changes that we'll get into the details are the individual rates, the standard deduction changes, the personal exemptions, the child and family tax credits, AMT, also known as alternative minimum tax, state and local taxes, including real estate taxes, the mortgage interest deduction, and something called the P's limitation. Now, over the next few slides, I have the tables for single filing, head of household, and married filing jointly, but I'm going to go ahead and skip forward to the comparison of the married filing jointly. This is the comparison of the old brackets and the new brackets. So on the left would be 2017, on the right is 2018. You'll notice that the first tax rate doesn't change, 10% on the same amount of income. But after that, the next 6 brackets all succinctly go down. One thing I do want you to note is where it has a taxable income limitation, or I should say range, that it doesn't remain the same across the board. So the first example you can see is in the third bracket down is that in the old bracket, it went from $77,401 to $156,150, taxed at 25%. Well, that now is expanded to $165,000, taxed at 22%. So it's not necessarily apples for apples when you're comparing. If I was in the 25% tax bracket, I'll now be in the 22% tax bracket.
Aaron, let me ask you a quick question. A lot of times a client will ask me, well, if I'm in a 37% bracket, does that mean all my income is taxed at 37%?
That's a really good question, and I think a pretty big misnomer is that, remember, there's your tax bracket and your effective tax rate. Your effective tax rate is taking your income tax divided by your taxable income. So, for example, if you have a married filing jointly couple who makes around $264,000 of taxable income, on the left, when under the old 2017 brackets, they were actually in the 33% tax bracket. However, because you're taxed at each tax rate for each level of income, their effective tax rate was actually closer to 24%. One of the keys that I want to show you is at the very end of these, where the top tax bracket previously had kicked in at $480,051. So every dollar you earned over that was taxed at 39.6%. Now it's increased to $600,000. And so every dollar that you make over $600,000 is now taxed at 37%. So although the tax rates are straightforward, it's not as simple as just looking at last year and this year and saying, oh, this is what my tax rate is going to be. Here's kind of a good bar example to show you the different ranges and how it dramatically changed of what income levels were taxed at what tax rates. One of the big things that you heard in the news media talked about the standard deduction. Now remember, the standard deduction is an amount that the IRS gives you to deduct from your adjusted gross income if you decide that your itemized deductions are not in excess of that. So in 2017, if you were married filing jointly, if you didn't have more than, let's say, real estate taxes, mortgage interest, and charitable contributions, and they didn't exceed $12,700, most likely you weren't taking any itemized deductions. You were taking the standard deduction, which meant you didn't have to gather all those receipts. Well, now, under the new law, they've almost doubled that standard deduction. So married filing jointly taxpayers are now going to get $24,000 in the standard deduction. What that means is if you were between or under $24,000 but greater than the previous standard deduction of $12,700 and you were itemizing, you may no longer need to itemize. It may no longer be prudent to gather all those charitable contributions or perhaps those medical expenses because you're just going to be allowed to take the standard deduction. Please note, if you're over 65, blind or disabled, there's an additional standard deduction that you tack on to that $24,000 or $12,000, whatever it may be. One of the big things that they got rid of is something called the personal exemptions. Remember, personal exemptions are what you claim for people you're supporting within your family or other relatives who may or may not be living outside of your home. You got an amount of $4,150 per person, so a family of 4. A couple with their 2 kids, each got $4,150 to deduct against their adjusted gross income. They completely repealed that and said, hey, we're going to consolidate this into the standard deduction by making it larger, but we're also going to expand the child tax credit and a new family tax credit to kind of help offset this reduction. One of the things that I want to point out is that if your income was over a certain level, some of these personal exemptions weren't applying to you anyway. They were getting phased out previously. So for some people, they're not going to notice the loss. But this is one of the questions the W-4 asked and when your employees or you were filling out your W-4 was specific to personal exemptions, which is why the IRS is putting out a new W-4 so that you can accurately reflect the withholding tables. They have not done that as of this morning. Let's talk about the expanded child and family tax credits. I lovingly call this the Marco Rubio tax credit because he was the one holdout that said, if you don't expand the child tax credit, I'm not going to vote for it in the Senate. And so as a last-minute joint committee taxation decision, they said, we're going to increase the child tax credit from $1,000 where it sits currently to $2,000 per kid. So just to give you kind of an example is that the exemption previously, you were getting, if you were in the 12% tax bracket, you were getting a $498 tax benefit from that personal exemption. Well, now you're getting $2,000 as a child tax credit. So even though you may have been getting the $1,000 child tax credit in this scenario, you're still getting more money. They also agreed to refund up to $1,400 per child, which that refund means that if your your credits exceed the tax that you've had withheld, you can get a refund of the credit, even more so than the taxes, which is a nice feature. For any of your non-child dependents, we typically see this for like parents or grandparents that you're supporting, or maybe another relative that may or may not live in your house. They give another $500 non-refundable credit. They also expanded it, so they said, hey, the child tax credit, once you reached $110,000 married filing jointly, started to get phased out, meaning you didn't get the full benefit. They increased that phase out from $110,000 to $400,000, which is a pretty broad base. So that means a lot more people are going to get that $2,000 per kid. And kind of below is an example of, again, if you'd had the exemption and been able to take the whole one, it would have been a tax break of $1,328, where here you might be at $2,000. One of the education provisions that I think a lot of people have been asking me about is the change to 529 plans. So previously 529 plans, you can only take or contribute to and then distribute amounts related to college or post-secondary education that you had set up for your children or beneficiaries of the 529 plan. They changed it to say, hey, now you can distribute up to $10,000 per child per year for qualified expenses like tuition from elementary and high schools that are private or religious schools. So now we're going to talk about deductions, and I laugh when I see this slide because simplification makes me always think, oh, it's so much better. It's going to be more simple. Well, simplification here does not mean better necessarily because it is taking away some deductions that you previously had. In theory, making it more simple for you to prepare your tax return, but maybe not impacting you in the way you want from a tax rate change or a taxable tax payment change. So some of the things we're going to go over in detail are the state and local taxes deduction, which include real estate taxes, mortgage interest, charitable contributions, personal casualty losses, medical expenses, job expenses and miscellaneous deductions, alimony paid, and moving expenses. So let's first talk about the itemized deductions, medical expenses. So remember, itemized deductions are what, if you add them up and they exceed your standard deduction, you're going to itemize them and it'll reduce your adjusted gross income. Well, medical expenses, they kept in the itemized deductions. There was talk of removing them, and they actually lowered the adjusted gross income threshold for the next 2 years. Today, for taxpayers under a certain age, is at 10% of your adjusted gross income. They now changed that to 7.5%, which means that if your medical expenses, when added up, exceeds 7.5% of your adjusted gross income, you get to deduct the difference if you itemize. The next big change, which I'm sure you heard a lot about in the news media, was state and local taxes. This was a really, really hot button, and it got a final approval where they said, hey, we're going to allow everyone to deduct a maximum of $10,000. And that maximum of $10,000 is a sum of your real estate, state and local real estate property taxes, personal property taxes, and state and local income or sales tax if elected. It's really important to note that this does not go toward real trade or business or rental real estate taxes that are deducted against income. If you're in a trade or business or rental real estate, this is really more for your personal real estate, whether that be land, personal residence, or second residence. I'm sure you heard that California, New York, Massachusetts, they were all in a big uproar related to this. As Floridians, a lot of us aren't going to see this impact us as much other than the real estate tax piece, but certainly if you're in another state, this could be a dramatic impact to your itemized deductions.
So Erin, did you hear as recently as I think yesterday that California is trying to figure out a way to make their income taxes be a charitable deduction instead of a tax?
I did. A lot of the governors, I even heard New York even pontificating that, is they're trying to basically find a way around to say like, hey, we're going to make it so that our taxpayers are still going to pay us the same amount of money, but get a federal tax deduction for it. So it'll be really interesting to see. One of the things I want to mention that came out that the New York governor, I think right after this law had passed, had sent out like an emergency order that basically said, hey, everybody can prepay their 2018 real estate taxes so that you can get the deduction in 2017 before they limit it. And the IRS actually was pretty quick to come out a couple days later and say, oh, no, we only allow you to deduct taxes that have been assessed. We don't allow you to prepay taxes that don't have an economic substance to them. So we got a lot of questions at the end of the year, can I prepay my taxes, which most counties in Florida wouldn't let you do. And it didn't end up mattering because the IRS said you can't deduct them anyway. Next change comes to mortgage interest. So the previous rules have been that if you had primary and secondary resident indebtedness when you acquired those house or those houses up to $1 million, you got to deduct all the interest on them. Once you exceeded $1 million, there was limitations that came into play. They went back and changed that and said, we're not going to let you do it up to $1 million. We're only going to let you do it up to $750,000. But we are going to grandfather in the people who have mortgages up to that $1 million. So they're going to still be allowed to deduct it going forward, as long as they don't get rid of it, buy a new house for another $1 million. Then it's going to be limited to the $750,000. You are also allowed to deduct up to $100,000 of indebtedness interest for home equity. So if you have pulled out $100,000 on your home and used it for personal expenses, you were able to deduct the interest expense on that. They completely suspended that. Now, I do want to give a caveat that if you use those proceeds for something that maybe perhaps happened in a trade or business, we can look at some interest tracing rules to still allow you to deduct it. But in general, if you used it for personal, that interest expense is no longer deductible. The next thing was charitable contributions. The first one is that previously you have been only allowed to deduct up to 50% of your adjusted gross income in contributions. We didn't see this hit on a lot of clients, but it did have an impact a lot of times for year-end planning, and they increased that limitation to now 60%. Another change, which was not very popular, especially I would say in Gainesville, was they said, hey, we're going to deny a charitable deduction for payments made in exchange for athletic seating rights. Where previously, if you made a Gator Booster contribution for basketball tickets, football tickets, or what have you, 80% of that contribution was a charitable deduction. They now said, nope, non-deductible, not going to allow it to happen. Casualty losses, they suspended through 2025. So remember, casualty losses is something happens to a personal asset of yours, whether it's your house, your car, jewelry, art. If you didn't get insurance that exceeded or insurance that covered the full amount of the fair market value of the loss, you had an availability to deduct that. So they said, we're not going to allow you to do this anymore unless you're in a federally declared disaster area. So what is reported to us on that is like very similar to Hurricane Irma, Maria, and Harvey that came through in August and September. We were considered a federally declared disaster area in Georgia, Texas, and Florida, and I think even South Carolina. If we had losses that exceeded our insurance at that point, we would still be allowed under the new law to deduct those losses. So they didn't take that part away. All right, I'm going to turn it over to Stacy for the next polling question.
Thanks, Erin. So in just a second, you'll see our next polling question, and we'll give you a couple seconds to respond. And we did get a comment that we went through the poll too quickly the last time around. So I'll leave it up for a few more seconds to give everybody an opportunity to respond. Okay, and we're going to close the poll and take a look at the results. Suzanne, what do you see?
Well, I think this is good news for our charities because the question is, will tax reform impact the amount that you give to charity? I think a lot of charities are concerned with the increase in the standard deduction that you won't be getting a deduction for this unless you're a very large contributor. And 78% of our respondents said that it will not impact them. 22% said that it would.
Okay, great. Let's talk more about itemized deductions that they took away. So miscellaneous itemized deductions subject to the 2% floor. So these have been suspended, and they include investment fees that you're paying out of taxable accounts. So this would include retirement account investment fees, the taxable investment accounts, tax preparation fees, unreimbursed business or job expenses that your employer doesn't cover. Previously, you've been able to deduct all of these as long as the aggregate exceeded 2% of your adjusted gross income. So to give you an example, if your taxable income or your adjusted gross income was $100,000, all of those items had to exceed $2,000 before they were even deductible. So a question I got at the end of the year was, hey, the tax preparation fees are no longer going to be deductible. Is that an issue? And a lot of times you weren't getting to deduct them anyway if they weren't exceeding 2% of your floor. So there's a lot of unnamed commercials that we see on the TV that talk about, and you can deduct our tax prep fees as part of your return. And the truth is you can put them as a deduction, but they don't actually get phased out and they're limited. So it's not a really big impact. Certainly some clients will feel the pain of this because they've had some high miscellaneous itemized deductions, and them going away will be a problem. The P's limitation, this was a limitation that they had put in place after a congressman that had been around for 9 or 10 years. They took away for a few years and they reinstated back in 2013 that says, hey, if you have an overall higher income, we're going to start to phase out some of those itemized deductions so that you're not getting the full benefit anymore. So they repealed it, which is great, but they then, as you see before on the past few slides, they limited the amount of deductions you were able to take in the first place. So you kind of don't have a double hit with the P's limitation gone. Some of the things related to retirement plans. Roth recharacterization. So previously, if you decided to convert your traditional IRA to a Roth IRA, and then you went to do your tax return the next year and said, oops, this is going to cost me more in tax than I originally thought, you were allowed to unwind that Roth conversion. They took it away. They said, now once you make the decision, that's it. You don't have a choice. It talks about here whether there'll be some relief for people who made that decision knowing they could unconvert it and whether that will be available. But it definitely goes into that planning conversation that you have with your financial advisor, your CPA, to make sure that when you make that decision, that's it. And then it did not change whether if you made a Roth contribution during the year and discovered, hey, I couldn't do it because my adjusted gross income was too high, you can still convert that to a traditional IRA contribution. It really has to do with the Roth conversions. And then if you decide to leave your job and you have a loan outstanding on the retirement account, the rule used to be in place that you had to repay it within 60 days of separating from the employer. They now moved that deadline to the due date of the employee's income tax return, which is nice because it gives people usually a lot longer to repay that loan, and 60 days is a pretty short period. Otherwise, it became taxable income to them. AMT, alternative minimum tax, this was always really complicated to explain to clients, and unfortunately we'll have to continue to do it because they did not get rid of it, unlike the corporate AMT, which they did fully repeal. The good news on the individual AMT is they increased the exemption amounts and they increased the phase out, as you can see here, so that I think a lot less people will actually be subject to AMT in the future. And some of the traditional add backs that have been in place for AMT, which were personal exemptions, miscellaneous itemized deductions, state and local and real estate taxes, well, they either limited those or got rid of those. So a lot of people aren't going to have those add backs to their AMT income, and they won't be subject to it anyway. There certainly are still some clients who have preference items who may have this as a consideration, so it's not completely out the door, but it is better. And then Kiddie Tax. So Kiddie Tax came into play when wealthier Americans used to say, hey, we're going to take some of our income and we're going to shift it over to our kids because they can pay a lower tax rate than we are. And so they put in place something that said, we're not going to do that. If your kids are under the age of 18 or 23 if they're still in college, we're going to subject their income to the parent's tax rate. They made two different tax regimes under this now going forward, where that if a kid has earned income like at an after-school job or during college, they're going to pay tax at the single filer rate, and unearned income, which is traditionally investment income, they're going to be taxed at rates for trusts and estates. And the bottom line is they'll no longer be tied to the parent's tax rate. One of the last things talks about above the line deductions, so moving expenses. So you used to be able to deduct qualified moving expenses. The typical reason that you were able to deduct them is because you moved for a job and were more than 50 miles away. That is gone unless you're still in the U.S. military. And as a side note to that if an employer reimburses you for moving expenses, it's now going to be considered taxable. And then alimony, effective for divorce or separation agreements after December 31st, 2018. So people have time to plan. This will no longer be deductible by the payer and includable by the recipient. So they eliminated that. And then kind of our last slide relates to estate and gift and generation skipping transfer tax. This is also known as the inheritance tax. Basically what you need to know is 2018, it is scheduled to be $5.6 million per person to be either left to beneficiaries in their estate tax-free or gifted during their lifetime. They effectively doubled that and said it's now $11.2 per person. Something to note that's important is this does sunset in 2025. So if you have any estate planning concerns that you might be back in an estate tax situation, after 2025 under the old rules, you may want to do some gifting or estate planning with your CPA and attorney now. And with that, I'm going to turn it over to Suzanne.
Well, thank you, Erin. That's a lot of information on the individual side, and I'm sure many of you have questions, and we will be following up with questions afterwards. I'm going to go ahead and take us now into the business side, and this is just some of the topics we're going to cover. There's a lot more in detail in the business law versus some of the individual stuff, but I'm going to try to hit the high level of the things that most people are interested in. So I'm going to go ahead and start with the C corporation tax rates. First, let me just step back and say a corporation can be taxed as either a C corporation, which means it's taxed at the corporate level, the corporation pays tax, or it passes its income through to the shareholders, and the shareholders pay tax at their individual level. So the corporation itself does not write a check. It's considered a pass-through. So most of what you're hearing in the press was related to the C corporation, or they just call it corporate tax rate, because the press doesn't distinguish between C corporations and S corporations, where the previous rates went between 15 to up to 35%. Now the new rate is a flat 21%. Now, I do want to remind everybody, because a lot of clients are surprised when I tell them that there is a Florida income tax for corporations. Most people are not aware of that if they don't already have a corporation that's paying tax in Florida, because we don't have a personal income tax. This is a 5.5% tax. So when I add the 5.5 to the 21 federal, we end up with a 26.5% overall corporate tax rate. The big issue with corporations is although they may pay less taxes at the corporate level, there's a double taxation. When a corporation makes a dividend distribution out to its shareholders, the shareholders pay tax on that again. Think along the lines of Apple stock, General Motors, whatever your favorite Disney stock may be. If you get a dividend from them, you pay tax on it again. And depending on your tax bracket, you could pay as high as 23.8% on that corporate tax. So the overall tax rate could be 44%. I will do an example later on in this presentation showing a C corporation versus an S corporation. It's a very basic example, but at least it will kind of show you the comparison of the two. So the big thing that was in the news was the pass-through deduction. You heard a lot about that, and what this is this is Congress' way to be able to give smaller businesses that are S corporations a tax deduction to help put them on a little better footing along with regular corporations.
Suzanne, let me ask a question. Does this only apply to S Corps, the pass-through deduction?
No, the pass-through deduction applies to all pass-through and individuals that may be paying tax on their personal tax return in a sole proprietorship or Schedule C, a single-member LLC that gets reported on their individual return, a partnership that gets reported on their individual, or obviously an S corporation. So it's all types of not only just pass-throughs, but anything that gets reported on an individual tax return, as opposed, so I think of it as everything except for corporations. Actually, the pass-through deduction applies to trust in the states too. So it's everything other than a C corporation. And this deduction is 20% of qualified business income. So if your business generates $1 million in income, you get a 20% deduction, so $200,000 of deduction, which in effect means 20% of your income you don't pay tax on. That's another way of saying, hey, I get a deduction. So if I have $1 million of income, I don't pay tax on $200,000, and I only pay tax on $800,000. Seems simple enough. We're done. We can go have coffee now. But not so easy. It's simpler, not simple. It's simpler if you're a taxpayer. Remember, this all flows through to your individual tax return. So you look at your individual filing, and if you are married filing joint with $315,000, life is a little bit easier. It's not simple to calculate, but it's easier to calculate. If you're single, it's $157,000. So if you're at those levels, there's no limitations. However, if you are in excess of $415,000 for married filing joint, or $207,000 for single $1,000, you start getting limits. So we have a speed limit sign on the 20% deduction. So now you have some work that has to be done. You have to determine what your 20% deduction is, and then you have to compare that to what 50% of wages, your W-2 wages would be for the entity, or 25% of wages plus 2.5% of the unadjusted basis of qualified property. It is a mouthful, but we also call that the Trump real estate rule, because that was kind of put in at the end because he obviously likes real estate. And so 2.5%, a lot of real estate ventures don't have payroll, and this was to enable them to be able to get some type of tax deduction. The other big item that comes into play if you're in excess of $415,000 joint income, or $207,000 for single, is it's not available to specific service businesses. And we're going to talk about that in a minute, but just keep that thought. So then you're going, well, what if I'm at $350,000? Well, don't worry. If you're at $350,000, we have phase-in limits that we can add to this very simple calculation and make it even easier to figure out what your tax deduction is. A little sarcasm there, but so there is a phase between those two limits. Specified service businesses. Any trade or business, you can read it, but what it is that it's a trade or business where the income is generated from a personal reputation or skill.
So Suzanne, I read this definition and I think, do you think this is descriptive enough so we can easily identify who falls into this service business?
No, there is going to be so much regulation that's going to determine how this is calculated. Stacy said in my introduction, I do a lot of work with real estate clients, and I've already got questions from agents and brokers. Does this apply to me? Probably so, because it's a service, and we're going to see a lot of laws coming into this play. One of the things I have is even in the medical field, we may have a doctor that's a personal service, but they may sell product too. And so can we separate those service lines within the entity to maybe be able to get this benefit? We're waiting for interpretations. We do know that some of this relates to an old law. One of the exceptions was architects and engineers. So if we have any architecture engineers on the line, you need to pay your lobbyists very well, because they did a great job, obviously better than the CPAs did, because we didn't get excluded from this, but they're not considered excluded under this rule, so their income will be eligible for the 20% deduction. So we're going to look at all of this. This is a big area when Aaron talked about us sitting down and helping clients go through what is going to qualify for this 20% deduction. So once we figure out whether our income is subject to a 20% deduction, then we start, and whether we're limited, we have to start looking at the limits on it. The first limit is 50% of wages. Now, if I am a manufacturer and I'm a single entity and I have a lot of payroll, this is probably not going to be an issue. I have lots of payroll that I'll be able to say, I calculate my 20% of my income, I take 50% of my wages, and I compare the two, and I see whether I can take my full deduction. I'm a very visual person, so I'm going to give you an example in a minute once I go through these definitions. However, it does not include guaranteed payments and payments to independent contractors. In addition to that, we've already gotten questions about, well, I'm a management company and I pay wages to this other company. I manage the wages and then we allocate them out to all the companies. Will that count as wages for the other companies? And the preliminary answer to that is no. Now, the payroll companies will probably love us because we'll tell you to go put payroll inside that company, but that's some of the analysis that we have to do, is to figure out what's the best situation to be able to get this full benefit. So that's wages. That's fairly easy. Then we have the 25% of wages plus 2.5% of unadjusted basis of qualified property. And I have to read it because it's just not natural to come up with anything like this. So you can imagine this was a very late deal when they calculated this. Qualified property. It's generally property that's being depreciated. So you look at your depreciation schedule, but so it'll include land, and it has to be over the period that is regular depreciation period or 10 years. And it's the original basis. It's what you originally paid for the property immediately after the acquisition. So you don't reduce it by depreciation. And I'm going to go through an example because I can't figure this stuff out without actually putting some numbers to it. It's the accountant in me. But Susan owns an office building and she leases it to a law firm. She purchased the building for $300,000 10 years ago, and she's paid off the mortgage, and the land cost $100,000. So she's got $400,000 into this property. Her net taxable rental income after expenses and depreciation about $40,000. Right, 10% return. That's not bad, especially after depreciation, right? But her married filed joint income is $500,000. This is she just owns it individually or in a single member LLC. She hires all contractors, so she has no employees. She's no W-2 wages. So now we have to look at, and this is common, we have this for a lot of clients. So now we have to look at, okay, well, the 20% deduction would be the $40,000 times 20%. I can do that math, that's $8,000. Then I have to go back and calculate the building purchase price, which was $300,000, couldn't use the land, times 2.5%, and I get $7,500. So she is going to be limited. She's not going to get the full 20% deduction. She's only going to get $7,500 deduction. That's an example of looking at the real estate piece of it, or the 2.5%, if we have to use that in any business. If we're a manufacturer, or Jim owns a company and he manufactures circuit boards, and in 2018, the taxable income was $500,000 after expenses and depreciation. The company paid employees $250,000 in wages. So calculating the pass-through deduction, that 20% of the $500,000 is $100,000, and then the $250,000 in wages times 50% is $125,000. So we get the full benefit of the $100,000. So this seems real simple. However, It's not that simple when you get into the actual calculation. If you have multiple entities where you're getting pass-through income or personal income, then leverage could be a problem. If you have a mortgage in one and not in the other, then you may be leaving some money on the table on these 20% deductions. I mentioned using common employees could be a problem. We don't have any wages. Buildings that are old, that have been fully depreciated, acquired a long time ago, where you have a low basis in them, the 2.5% is not going to be a big number. The swings in income or income between entities, this is all, really, I see this as being one of the biggest areas that we're going to have to dig deep into and figure out whether or not, how we can maximize this deduction. And just I promised you, I know y'all been holding your breath, just waiting to see this. So if we compare a S corporation or a pass-through entity to a C corp, and I used the highest tax rates for this example. So we have $100 of business income on the pass-through. We get a 20% deduction and $80 in taxable income. Highest tax rate of 37% would be $20. Business income, and we deduct what we pay in tax. The net effective overall rate to the taxpayer is 29.6%. If we look at a C corporation, we did the analysis earlier that we, in effect, paid 21% of tax at the corporate level plus a state tax. I will mention that state tax is deductible, so you do have a little bit of an algebraic equation there, which I did not do because I didn't want to make this a math class. So the dividend, you end up with $73.50 in the corporation. That looks good on the surface because we could end up with more money, $73.50 versus $70.40. However, when you go to take it out of that corporation, you have a double taxation and you end up with $56 and your overall tax rate is 44%. This is a very basic example. There's a lot of different issues related to whether this, we go into when you take the money out, time value of money, a liquidation event, do you not take it out, is there AMT tax? So, or do you get, what if your entity doesn't get the full 20% deduction? It changes all of these calculations. This is obviously not a simplification of the tax law for businesses. Okay, so that's about all I have to say about about a pass-through deduction. I'm sure
that's all.
That's all.
It's complicated.
It is very complicated. Moving on to bonus depreciation. This is one area that it did impact for 2017, that if you bought an asset after September 27, you will be able to get 100% bonus depreciation. That means you can write off 100%. And one of the big things that they changed was they included used property. You used to only be new property because it was supposed to be an incentive to buy new to get manufacturing going. But because now this is an overall incentive to invest in business, it does not matter whether it's new or used. For the most part, acquisitions of real estate does not qualify for bonus depreciation. So the next item that happens is what we have is Section 179 expensing. For a lot of companies with the bonus depreciation being at 100%, the Section 179 won't be as relevant, but it did increase. You could take up to $500,000. Now, starting 2018, it's $1 million. And the other, it also applies to new and used property. They did expand the definition of what qualifies, and this is one area that we'll be looking at because they did include lodging, which is apartment complexes was a big area for this, and they also said that you can Section 179 write off roofs and pieces of the building when you do replacement if it's not placed in service the first year. The thing about Section 179 is you cannot create a loss with it. A bonus depreciation, you can create a loss, but Section 179 you can't. So we're going to see, we saw the reduction in tax rates. What we're going to see a little bit of what we saw in the individuals where we have reductions in deductions. Try to say that 10 times fast. But one of the items is interest expense deduction. This is for business interest. And before, the limitation is that you can only deduct 30% of your interest of your adjusted gross, your taxable income. This only applies to businesses with gross receipts in excess of $25 million. So there's a lot of businesses that this won't apply to, but for the ones they do, this is very significant. And it does get tested on a group basis. So if you have 4 businesses with the same ownership, you can't say, oh, I'll just do 4 companies so I can keep my company below 25 million. It has got to be aggregated to test it. The interest is not lost, it gets carried forward. And there's some more deduction limitations on it. The biggest thing is how you define adjusted taxable income. And I have an example, which is probably the easiest thing to go to and look at with regard to the deduction. So if they have a manufacturing plan of 50 million of revenue, 5 million of taxable income, they have $2.5 million of interest. And so what happens in the example, you'll see under the current 2018 through 21, the taxable income will be 5 million. And at 30%, you can only deduct $1.5 million of the $2.5 million in interest that you actually paid. So you have an interest carryover of $1 million. So this could be very significant. After 21, you're no longer, you have to take out depreciation. And so the deduction, the limitation increases, and now you're only able to deduct $975,000. So this is going to be pretty significant for a highly leveraged business. Another thing that the IRS did, you have to remember they're trying to do some revenue generators. In the past, we could have a business loss and deduct all of it against other income. What they did was they said, no, you're only going to be able to deduct if you're married filing joint $500,000, and if you're single taxpayer $250,000. You can only deduct 80% of the loss. So on an example, again, I'm a visual. So this taxpayer, Helen, invested in Bitcoin, I guess, because she had $2 million of other income, and then she had $800,000 business loss. So under the current law, her taxable income would be 1.2. Under the new law, she would only be able to deduct $500,000 of that $800,000 and would have to carry $300,000 of that loss forward.
Now, Suzanne, I think this might be one of the areas that, again, is kind of gray in determining what the business loss is. Is it aggregate of a bunch of different entities? Is it on an entity-by-entity basis? So it's definitely something that will have to be clarified going forward, because it will impact a lot of clients.
Yes, this is definitely an area where there's been a lot of questions, and we are waiting anxiously to see the regulations and how they're going to apply this. And the other item was net operating losses. If you did have that loss, if you did have a loss and you carried it forward, you can only offset up to 80% of your income. In the past, we were able to offset 100% of your income. Now it's only 80%. You can't carry the loss back to get taxes that you paid, and so now you have to only be able to carry it forward. One quick comment, like-kind exchanges, that they're only eligible for real property. In the past, if you traded a vehicle in or traded a plane, etc., you didn't have to recognize a gain on the fair market value. Now you will, but we don't think this will have a big impact because you probably replaced it and you'll be able to do bonus depreciation and write off the replacement vehicle. But this was an interesting change in the law. And my final slide is what I call business potpourri, just because it's fun to say. And there's a lot of things that, and you've seen a little bit of this in the press, but things like no deduction for entertainment, no deduction. So in the past, it was meals and entertainment was limited to 50%. Now entertainment is not deductible at all. So those clients that are out there listening that are business, we're going to have to separate now your travel, which is 100% deductible, meals, which is 50% deductible, and entertainment, which is not deductible. And now we're going to have to determine what exactly entertainment means. So that's going to be more fun. The other area that we're waiting on interpretations is this is right out of the law. There's no deduction for membership dues for any club organized for business, pleasure, recreation, or other social purposes. In the past, they had limited country club dues and things like that, but the fact that they threw business in here, we don't know what that means. We have a lot of questions. If you belong to a professional association, is that a business club? We may end up seeing what's the difference between a dues and a subscription, maybe for technical information. So I think we're going to see a lot of interpretations. This is another area where we're going to have to ask questions and have clients separate these items on their expenses. So this is an area that we'll be able to sit down with clients and help them kind of as we get more interpretations. The other item, meals provided to employees at an employer place of business, only 50%. It used to be 100. A lot of questions about what does that mean if I order in from Four Rivers, and is that a meal provided at my place? Because is it a cafeteria? And of course, you'd love to see politics get into some of this stuff, but there's no deduction for a settlement of a sexual abuse harassment suit that is subject to a non-disclosure agreement. And I have to believe that had something to do with what was going on in the press recently, but I just never know. And then finally, a little good news for any companies that are paying family medical leave. There'll be tax credits for that. There's a lot of other business provisions that we just don't have enough time to go over, so stay tuned on more of that. Check our website.
And with that, I'm going to turn it over to Erin to just finish talking about nonprofits.
Yeah, and I just have a few slides here on tax reform for nonprofits because, like I said, this law impacted everybody. And we already talked about one of them where the charitable deduction got denied for contributions in exchange for athletic seating events. And one of the questions that I think Suzanne alluded to earlier is charitable giving. How is this going to affect it? And this isn't a statement that is meant to say to de-incentivize you or incentivize you, but this does kind of tell you, under the new tax law, what are going to reduce incentives for charitable giving? Well, maybe doubling the standard deduction. People may not be as willing to give if they're not getting a tax deduction for it, but there's a planning opportunity there. Maybe you double up your charitable contributions in a year so that you can itemize your deductions. Doubling the estate tax exemptions, repealing the deduction for tickets to college athletic events. But they did put in there some incentives. So they repealed the piece limitations, so you're no longer losing potentially a part of your itemized deductions if you're over a certain income level. And they increased the charitable contribution deduction limit from 50% to 60% so that you can get more of a benefit. Some of the changes that are going to impact, we think, our nonprofits a lot is the change to executive compensation. So it changes compensation practices for executives and other highly compensated employees. It creates a class of covered employees, including a principal executive officer, a principal financial officer, and 3 other most highly compensated employees, and imposes a 21% excise tax on excessive compensation in excess of $1 million. And that includes excess parachute payments paid to those covered employees. They did make an exception for healthcare professionals, as a lot of our hospitals are nonprofits, so they didn't want to disincentivize them from hiring doctors who are over that $1 million limitation. But that 21% excise tax is a hefty one, in my opinion. They also made some changes to unrelated trade or business income. The most significant change is that current law allows exempt organizations to net their UBTI gains and losses if they have multiple businesses and investments. They basically allow them to aggregate them to come over with an overall UBTI income to pay tax on. The new law now requires separate tax calculations. So this could punish exempt orgs that have multiple business lines where one may have a current tax loss that has to carry forward to offset income in the future. It can't offset other lines of business that are created in UBTI. This will change both calculation and investment strategies. And an organization's unrelated business income will also be increased by amount of certain fringe benefit expenses. So tax-exempt entities will be taxed on the value of providing their employees with transportation fringe benefits, on-premises gyms, and other athletic facilities by treating the funds used to pay for those benefits as UBI and maybe subjecting those employee benefits at a 21% corporate tax rate. So that's a big one on there. All right, Stacey, I'm going to turn it over to you for our final polling question as we're getting to the end of our webinar.
Thank you, Erin. You'll see the final polling question appear on your screen. As a reminder, for those of you looking for CPE credit, make sure you respond to this poll, and we'll give everybody a couple more seconds to respond. Okay, and let's share the poll. Suzanne, do you want to walk us through the results?
Well, I'm not surprised by that result. It definitely wasn't a simplified tax law. 77% say it's not simpler. I think for the individuals, there are that don't have to itemize and the child tax credits, it will be simpler for them. But the majority of people, 77, respond that no, this is definitely not similar. We are not looking at retiring anytime soon out of our business.
No, it's not the postcard solution that they promised, is it? Yes, I heard that many times. That kind of wraps up our webinar. I think we've gotten a lot of questions, right, Stacey, that people have already emailed in or have submitted, and we encourage you to do that. And like we said, we'll go through them and answer them personally to you so that you get the answer. Although I would caveat it, say don't be surprised if the answer is we don't know yet, or that's a gray area. And we also want to let you know that we've already been asked to do a number of speaking engagements for different clubs, organizations, associations, and we're happy to do that, and we're happy to tailor the presentation to whatever you're talking to. If it's a construction association, we'll tailor it to construction clients or construction attendees. And someone within James Moore & Company would be happy to do that. So please let us know if you have a need for that. As again, we know we only covered a smidgen of what was in the tax law. We hope it answered some of your questions. It probably prompted some additional ones, but we want to be able to help educate everybody and make the best decisions kind of going forward.
Great. Thank you, both Erin and Suzanne, for the wonderful information. You've given us a lot to consider. We are out of time. Thank you all once again for attending our webinar. We hope the information was beneficial to you, and we hope you have a great day.